Imagine retiring 10 years earlier than you planned. Today, I'll reveal how some investors are beating the S&P 500 and setting themselves up for early retirement. Stay tuned to find out if this could be you. Hello, save investors and future retirees. Welcome to You Can Beat the Stock Market program, your go-to source for financial wisdom. In this channel, I talk about how to beat the stock market, and in today's episode, we're diving deep into a strategy that could potentially expedite your journey to retirement. We're talking about real examples, actionable steps, and demystifying the stock market. I am Francisco, a seasoned investor and your guide on this journey to financial freedom. Today's theme is all about retiring early by beating the S&P 500 with smart stock investments. Whether you're a seasoned investor or just starting, this episode is packed with insights for you. Imagine you are in a race, not just any race, but one where your future comfort and freedom are at stake. This race is against a powerful runner named the S&P 500. It's not just about crossing the finish line, it's about outrunning this seasoned athlete. Beating the S&P 500 in investing means your portfolio is outpacing this well-regarded benchmark index, known for its stable and consistent returns. Now, why is this crucial for early retirement? Think of the S&P 500 as a pace setter in our race. It represents the average speed you need to maintain to reach a standard retirement age comfortably. But what if you want to retire early? You need to run faster, push harder, and cover more ground in less time. That's exactly what beating the S&P 500 does for your investment portfolio. Let's use an analogy. Imagine two gardeners, Alice and Bob, both growing apple trees. Alice's trees grow at the same rate as everyone else in her neighborhood. This is like matching the S&P 500. But Bob discovers a special fertilizer. His trees grow faster, yielding more apples years before Alice's. In the world of investing, Bob's trees are your investments that beat the S&P 500. They are growing your wealth faster, allowing you to harvest the fruits of your labor sooner. In this case, retire early. But here's the catch. It's not just about randomly picking the fastest growing trees or stocks. It's about creating a diverse orchard, a well-balanced portfolio of various stocks that have the potential to beat the market average consistently. This means doing your homework, understanding market trends, and sometimes taking calculated risks. In essence, beating the S&P 500 is like winning a strategic race against time. By carefully selecting and nurturing your investments, you're not just aiming for good returns. You're accelerating your journey towards financial independence and the freedom to retire when you choose, not when the standard dictates. In the world of investing, there's a common misconception that beating the S&P 500, a benchmark index representing the performance of the 500 large companies on the US stock market, is merely a stroke of luck, akin to hitting the jackpot with a few random stock picks. However, this belief oversimplifies a complex and nuanced process. Beating the S&P 500 consistently is not about sporadic wins or gambling on hot tips. It's a disciplined approach, blending analytical rigor with strategic foresight. Investors often mistake short-term gains from a handful of stocks as beating the market, but true outperformance is measured over longer periods and across market cycles. The science behind this involves meticulous research, understanding market trends, and diversifying investments. It's about identifying companies with strong fundamentals, growth potential, and resilience in various economic conditions, not just grabbing stocks that are currently in vogue. This approach requires patience as well as an understanding of risk and how to manage it effectively. Stock screeners allow investors to filter stocks based on specific criteria, such as market capitalization, earnings growth, dividend yields, or industry sector. This targeted approach enables you to quickly identify companies that meet your investment criteria, saving hours that would otherwise be spent manually sifting through financial statements and reports. For instance, if you're looking for high-growth tech companies, you can set parameters to include only those with a certain percentage of revenue growth. Many stock screeners offer real-time data and analytical tools to track market trends. They provide insights into price movements, trading volumes, and historical performance, which are crucial for timing your investments. By observing patterns and trends, you can make more informed decisions about when to buy or sell stocks. Some screeners also include news feeds and expert analysis, keeping you updated on recent developments that could impact stock performance. Keeping you updated on recent developments that could impact stock performance. Diversification is key to managing risk in your portfolio. Stock screeners help in identifying a range of stocks across different sectors and geographies. You can set filters to ensure a balanced mix of industries, asset classes, and market caps. This approach minimizes the risk of heavy losses if one particular sector or market underperforms. Therefore, while luck can play a role in any investment, consistently outperforming the S&P 500 involves a methodical and informed strategy. Far from the randomness of luck, it's about making educated decisions based on data, trends, and economic indicators, and continually adapting your strategy to the ever-changing market dynamics. And the stock screeners streamline the investment process by providing a wealth of data and analytics at your fingertips. They empower investors to conduct detailed research, stay abreast of market trends, and build a diversified portfolio with efficiency and ease. When exploring stocks that have historically outperformed the S&P 500, it's essential to look beyond the usual suspects, the tech giants, and consider the unexpected underdogs that have shown remarkable performance. This exploration uncovers a diverse range of companies, each with unique characteristics contributing to their success. Tech giants. These are the household names in technology like Apple, Amazon, and Google. Their dominance in the market is driven by continuous innovation, strong brand loyalty, and significant market share in their respective sectors. These companies often lead in cutting-edge technology, from AI to cloud computing, driving their long-term growth and making them consistent overperformers against the S&P 500. Their large size and global reach provide stability and resilience even in volatile markets. Contrary to popular belief, it's not just the tech giants that beat the S&P 500. Several lesser-known or emerging companies across various sectors also achieve this feat. These underdogs might be in industries like renewable energy, biotechnology, or niche technology sectors. What makes them tick is often a combination of innovative products or services, strong management team, and being in a rapidly growing industry. Their smaller size compared to the tech giants can make them more agile and able to adapt quickly to market changes, leading to unexpected growth spurts. Both types of stocks share common traits: innovation, a strong competitive edge, and the adaptability to adapt to changing market conditions. However, the risk profiles are different. Tech giants usually offer more stability, but might have slower growth rates compared to their earlier days. In contrast, underdogs carry higher risk due to their smaller size and untested markets, but the potential for rapid growth can be significantly higher. Diversifying investments across both these types allows investors to balance risk and reward, aiming to achieve returns that beat the S&P 500 while mitigating the potential downsides of investing solely in one type of stock. Beating the S&P 500, a benchmark index reflecting the performance of the 500 large companies in the U.S. stock market, is often seen as a hallmark of investment success. However, this achievement signifies more than just obtaining higher returns. It's a strategic pathway to accelerated wealth growth, which is instrumental in achieving early retirement. The concept of beating the S&P 500 is rooted in the principle of compound growth. When your investments consistently beat this benchmark, They not only earn higher immediate returns but also provide a greater base for future earnings. This compounding effect over time can significantly amplify your wealth growth. For instance, an annual return of 10% versus 8% on a substantial investment can translate into a remarkable difference in total wealth over a couple of decades. This accelerated growth is critical for those aiming for early retirement. The traditional model of retirement planning often relies on a steady but gradual growth trajectory, assuming a standard rate of return aligned with the broader market. However, by setting these average market returns, you're effectively shortening the time needed to accumulate the necessary retirement funds. It's like running a race at a faster pace than expected, reaching the finish line sooner. Moreover, beating the S&P 500 can provide a cushion against inflation and market volatility, with a larger investment corpus grown at a faster rate. You have more flexibility to withstand economic downturns without significantly impacting your retirement timeline. In essence, consistently outperforming the S&P 500 isn't just an exercise in financial acumen. It's a strategic approach to accelerating wealth accumulation. This strategy requires a careful balance of risk and reward, astute market analysis, and a proactive investment strategy. By doing so, investors can turn the dream of early retirement into a tangible goal, secured on a foundation of robust financial growth. Let me show you three approaches which may help you. Tech investor. Investing in tech stocks and recognizing the potential in emerging tech markets, you may invest in a mix of established tech giants and promising startups. Your portfolio may include stocks like Apple, world-renowned for its smartphones, computers, and other electronic devices, and Alphabet, a holding company. Internet media giant Google is a wholly owned subsidiary. Google generates 99% of Alphabet revenue, of which more than 85% is from online ads. Google's other revenue is from sales of apps and content on Google Play and YouTube, as well as cloud service fees and other licensing revenue. The tech investor may include also some lesser-known companies in the AI like Palantir Technologies, an analytical software company that focuses on leveraging data to create efficiency in its clients' organizations, and renewable energy sectors like Enphase Energy, a global energy technology company which delivers smart, easy-to-use solutions that manage solar generation, storage, and communication on one platform. These stocks have been consistently beating the S&P 500, thanks to their innovative products and market dominance. Through disciplined investing, your portfolio may grow significantly, allowing you to retire early. The second approach is the diversified investor. You may diversify your investments across various sectors, including healthcare, consumer cyclical, and technology. In the healthcare sector, there's HCA Healthcare, a Nashville-based healthcare provider organization operating the largest collection of acute care hospitals in the United States. In the consumer cyclical sector, there's Louis Vuitton Moet Hennessy, commonly referred to as LVMH. Higher profile brands include Louis Vuitton, Burberry, Fendi, Gucci, Tag Heuer, Glen Morangi, Sephora, and Benefit. In the technology sector, there's NVIDIA, a leading manufacturer of graphics processing units, GPUs, and AI technology. By choosing companies known for strong fundamentals and consistent growth, outbeating the S&P 500 becomes easy. This approach isn't about picking the next big stock but about steady growth and risk management. The third approach is the aggressive investor. You may also adopt a more aggressive investment strategy. You may allocate a significant portion of your portfolio to high-growth stocks, particularly in the biotech and fintech sectors. While riskier, these stocks had the potential for high returns and indeed delivered, significantly beating the S&P 500. As an example, we have Vertex Pharmaceuticals, a global biotechnology company that discovers and develops small molecule drugs for the treatment of serious diseases. Its key drugs are Kalydeco, Orkambi, Symdeko, and Trifecta Calf-Trio for cystic fibrosis, where Vertex therapies remain the standard of care globally. Riot Platforms is a fintech that focuses on Bitcoin mining and blockchain technology. These examples demonstrate how different strategies of focusing on stocks that beat the S&P 500 can lead to successful early retirements. The key lies in aligning investment strategies with individual risk tolerances and life goals. The notion that stock market investing is solely for the experienced is a common misconception. In fact, the strategy of investing in stocks that have the potential to beat the S&P 500 can be accessible even for beginners. The key lies in leveraging resources designed to simplify the investment process. For instance, stock screeners can help newcomers identify high-potential stocks based on predefined criteria, such as market performance, industry sector, or financial health. Additionally, numerous educational platforms offer straightforward guidance on investment basics, from understanding market trends to portfolio diversification. Investment mechanisms also present an easy entry point, offering automated, algorithm-driven investment strategies tailored to individual risk tolerances and goals. By starting small, continually educating oneself, and utilizing these tools, beginners can gradually build confidence and competence in navigating the stock market and developing a portfolio geared towards beating the S&P 500. Investing in the stock market can be a powerful tool for wealth creation, but it's fraught with potential missteps, particularly for those new to investing. One of the most common pitfalls is making investment decisions based on trends or hearsay, a practice that can lead to disappointing results. Understanding why this approach is flawed is crucial for an investor. Investing based on trends might seem like a straightforward path to quick gain, but it's often akin to chasing the wind. Market trends are influenced by a multitude of factors, including economic indicators, geopolitical events, and investor sentiment, which can change rapidly and unpredictably. By the time a trend is widely recognized, the opportunity for significant gains often has passed, and the risk of entering at a market peak increases. Moreover, trendy stocks are often overvalued, having risen in price due to high demand, not necessarily because of strong fundamentals. This scenario sets up a classic buy high, sell low situation, which is the antithesis of sound investing principles. Making investment decisions based on hearsay or tips from friends, family, or online forums is another common mistake. This approach is fraught with risks, as such advice is seldom based on thorough research or an understanding of an individual's financial goals and risk tolerance. Hearsay does not consider the broader market context or the specific financial health of a company. Investing based on casual recommendations can lead to a portfolio that's misaligned with one investment's objectives, excessively risky, or overly concentrated in certain sectors or stocks. The herd mentality in investing, where individuals mimic the trades of the majority, can lead to inflated asset bubbles and subsequent crashes. When investors pile into the same stocks or sectors, pushing prices to unsustainable levels, the risk of a sharp correction increases. This behavior can lead to significant losses, particularly for those who enter the market late in the cycle. Rather than following trends or hearsay, successful investing should be grounded in fundamental analysis. This involves evaluating a company's financial health, management quality, market position, and growth potential. By understanding the intrinsic value of a stock and its long-term prospects, investors can make more informed decisions, reducing the influence of market volatility and speculation. A disciplined approach to investing involves setting clear goals, diversifying investments, regularly reviewing and rebalancing the portfolio, and maintaining a long-term perspective. By avoiding the temptation to follow the crowd or act on unfounded tips, investors can focus on building a solid, well-researched portfolio that aligns with their financial objectives and risk tolerance. In summary, while trends and hearsay may offer the allure of quick gains, they are unreliable foundations for investment strategies. A more sustainable approach is grounded in research analysis and a disciplined adherence to investment principles. Investing can often seem like a straightforward path guided by common sense principles. Invest in what's growing, avoid what's falling, and follow the market wisdom. However, the right way to make investment decisions can be often counterintuitive, challenging conventional thinking and requiring a deeper understanding of market dynamics. Conventional wisdom suggests avoiding volatile stocks. However, volatility can be an investor's ally. It creates opportunities to buy quality stocks at discounted prices during market downturns. Astute investors understand that market fluctuations are normal and can be leveraged for long-term gain. By adopting a contrarian view, one can capitalize on the market's overreactions, buying when others are selling in fear and selling when others are buying in greed. Many investors obsess over stock prices, equating a low price with a bargain and a high price with overvaluation. This is misleading. The right approach is to assess the value, not the price. A 500 stock can be cheap if its underlying business is strong, growing, and undervalued by the market, while a $5 stock can be expensive if its business is weak or declining. The key is to understand the business behind the stock, its earnings, growth potential, competitive advantage, and management quality. Diversification is widely preached but often misunderstood. It's not just about having a large number of stocks in a portfolio. Over-diversification can dilute returns and add unnecessary complexity. Instead, the focus should be on diversifying across different sectors and asset classes and, more importantly, on the quality of investments. Holding a handful of well-researched high-quality stocks can be more effective than spreading investments too thinly across mediocre ones. The modern investment world is obsessed with short-term performance, but the greatest gains are often realized over the long term. Many successful investors are those who invest with a horizon of years or even decades. They understand that real wealth is built slowly and that the most lucrative investments are often those that take time to mature. Patience also means resisting the urge to constantly trade. Frequent trading often incurs high costs and taxes, which can erode return. Investing is not just about numbers and analysis, it's also about psychology. Fear and greed are powerful forces that can lead to poor decisions. Successful investing requires mastering one's emotions, maintaining discipline, and adhering to a predefined investment strategy, especially during market extremes. The best investment opportunities are often found in areas that are uncomfortable or unpopular. Sectors that are facing temporary headwinds or companies going through short-term challenges can present valuable opportunities, as they are frequently undervalued. Investors who have the insight to see beyond the current troubles can reap significant rewards as these companies recover. Going against the consensus can be daunting, but herd mentality often leads to bubbles and crashes. The most successful investors are those who are not afraid to challenge popular opinions and look for facts that contradict the majority view. This does not mean always betting against the market, but it does mean independently analyzing and being wary of widely held beliefs that may have led to overvaluation. While seeking returns is the goal of investing, managing risk should be the priority. This involves understanding the potential downsides and having a plan to mitigate losses, such as setting stop-loss orders or having a well-balanced portfolio. It's about not letting the pursuit of high returns blind one to the potential risks. The magic of compounding is often underappreciated. Even modest returns when compounded over a long period can lead to substantial growth in wealth. This means that even small, consistent investments can grow significantly over time emphasizing the importance of starting early and staying invested. The market is ever-changing, and what worked yesterday may not work tomorrow. Successful investing requires continuous learning, staying updated with market trends, and adapting strategies as needed. It also involves being open to new ideas and technologies that are shaping the future of investing, such as AI and blockchain. In conclusion, successful investing often involves approaches that may seem counterintuitive at first glance. It requires a blend of discipline, patience, independent thinking, and a deep understanding of market psychology and fundamentals. By embracing these principles, investors can make more informed decisions, manage risks effectively, and increase their chances of achieving long-term financial success. Starting your investment journey can be both exciting and daunting, but taking the first step is simpler than you might think. The initial move is to open a brokerage account, which is your gateway to the stock market. Here is a straightforward guide. Start by selecting a brokerage firm. They are traditional brokers offering comprehensive services and online brokers known for lower fees and ease of use. Consider factors like commission fees, minimum account requirements, available tools and resources, and ease of platform use. For beginners, an online broker with educational resources and user-friendly interface might be ideal. The process is typically done online. You'll need to prove personal information, including identification and financial details, and answer questions about your investment goals and risk tolerance. This helps the broker provide suitable investment recommendations. Once your account is approved, you'll need to deposit funds. This can usually be done via bank transfer. Start with an amount you're comfortable with and can afford to invest. Before investing, research to identify high potential stocks. Look for companies with strong fundamentals, growth potential, and a good track record. Utilize the research tools and resources provided by your brokerage. Once you've identified your stocks, it's time to invest. You can buy shares directly through your brokerage account. Start with a small number of shares to get comfortable with the process. After investing, monitor the performance of your stocks. Use this as a learning opportunity to understand market movements and refine your investment strategy. Remember, investing is a marathon, not a sprint. Starting with these small steps, you're setting the foundation for a future of informed and thoughtful investing. Keep educating yourself, stay updated on market trends, and be patient. Your journey in the world of investing has just begun. Investing in the stock market is a journey filled with complexities and nuances, and often the most effective strategies seem counterintuitive. Understanding where most go wrong and how to approach these challenges differently can be pivotal in achieving investment success. The common pitfall in investing is the lack of research and patience. However, the counterintuitive aspect lies in understanding that effective research is not just about analyzing financial statements or market trends. It also involves understanding the broader economic environment, the specific industry dynamics, and even the company's management and corporate governance. Patience, on the other hand, isn't just waiting. It's strategic waiting. This means not reacting impulsively to short-term market fluctuations, but waiting for the right opportunity that aligns with your long-term. This means not reacting impulsively to short-term market fluctuations, but waiting for the right opportunity that aligns with your long-term investment strategy. Risk tolerance is often viewed as a static metric. However, a more nuanced approach is to see it as a dynamic concept that evolves with your life stage, financial situation, and market conditions. It involves regularly reassessing your comfort. It involves regularly reassessing your comfort with risk and adjusting your portfolio accordingly. Creating a simple investment plan doesn't mean setting it and forgetting it. It involves establishing a clear, achievable goal, but also incorporating flexibility to adjust your strategy as your goals evolve or market conditions change. This could mean periodically shifting your asset allocation or exploring new investment opportunities. The debate between timing the market and time in the market is ongoing. The counterintuitive truth is that it's not about choosing one over the other, but understanding how to blend both strategies. It's about being in the market to ensure you don't miss out on long-term growth while also being mindful of market cycles to make informed decisions about entry and exit points. A robust investment strategy often involves contrarian thinking. It's about looking for value where others see none and being cautious when others are greedy. This could mean investing in undervalued sectors or stocks that are out of favor but have strong fundamentals and growth potential. Regularly reviewing and rebalancing your portfolio is crucial, but it's not just a matter of doing it at set intervals. It's about being responsive to significant market events or changes in your personal circumstances, which might necessitate more frequent adjustments. Improving your investment acumen is not just about increasing your financial knowledge. It also involves developing an understanding of behavioral finance, how psychology affects investment decisions, and learning from your past investment experiences, both successes and failures. Instead of fearing market volatility, embrace it as an opportunity. Volatility can provide entry for buying quality assets at lower prices. The key is to maintain a long-term perspective and not get swayed by short-term market movements. Understanding the potential highs and lows of investing is not just about financial preparedness, but also psychological. It's about being mentally ready for the possibility of loss and having the fortitude to stick to your investment plan even in down markets. While diversification is a key risk management tool, managing exceptions and risks also involves understanding the interconnectivity of global markets and how different asset classes react to various economic events. It's about not just spreading your investments across different assets, but also understanding how these assets interact with each other. Successful investing requires a counterintuitive approach that goes beyond traditional advice. It involves a deep understanding of the market, a dynamic view of risk tolerance, a flexible yet simple investment plan, a blend of timing and time in the market, contrarian investment strategies, responsive portfolio management, a broad approach to improving investment acumen, embracing market volatility, psychological readiness for the highs and lows, and a comprehensive view of risk management. With this approach, you are not just following the herd, but paving your own path to investment success. Today, we've covered a lot about beating the S&P 500 for early retirement. Remember, every journey starts with a single step, and your early retirement could be closer than you think. Stay tuned for more insights. And if you want to learn how to beat the stock market so you can retire earlier, or just achieve financial goals faster, like buying a home, funding education, buying a Ferrari, or whatever you might choose, hit the like and subscribe buttons and turn on notifications. Until next time, and happy stock investing!